Welcome to a conversation about the inner workings of private equity, told by someone who spent a quarter of a century inside it. Seides speaks with Sachin Khajuria, a former partner at Apollo and a 25-year veteran of the industry, whose book, 2 and 20, offers a rare insider's account of how the business really operates. The title itself names the industry's classic economics, roughly 2% in annual management fees and 20% of the profits, the carried interest that makes partners wealthy. Over the course of the discussion, they cover why Sachin wrote the book, what private equity does exceptionally well, where it needs to improve, how it has gone mainstream, and where the opportunities and risks lie ahead. What follows is organized by theme, so the argument is easy to follow. Why write 2 and 20? Sachin's motivation was to pull back the curtain. Private equity has grown into one of the most powerful forces in the global economy, yet it remains poorly understood outside a narrow circle on Wall Street. He wanted to explain, in human terms, what actually happens inside these firms, the intensity, the judgment, the culture, and to do so through vivid, real stories rather than jargon. Part of his aim is education. He believes private equity has become an indispensable part of the economy and deserves to be understood by ordinary people, not treated as a black box reserved for insiders. The 3 virtues of the best firms. At the heart of the conversation is Sachin's framework for what separates elite firms from the rest, and it comes down to 3 qualities. The first is alignment. The best firms align themselves with their limited partners, their investors, in a way that goes well beyond economics. The partners genuinely put their investors' outcomes first, and their own capital is on the line alongside them. The second is what he calls the library, a deep accumulated store of data, relationships, operating executives, knowledge, and know-how built up over decades and across hundreds of deals. That library gives a firm an edge that cannot be quickly replicated. The third is temperament, the discipline to take a long-term view and the flexibility to pivot when circumstances change. Firms that possess all 3, he argues, are the ones that endure. And he is candid that not every firm lives up to this ideal. There are cases where firms have not acted in their investors' best interests. Culture and diversification. Underneath those virtues sits culture, and culture, Sachin insists, comes from the top. The tone set by a firm's leaders shapes how everyone below them behaves, how they treat investors, and how they make decisions under pressure. He also observes that firms which diversify their strategies tend to outlast those built around a single approach. A one-strategy firm can thrive when its niche is in favor, but the firms that survive across cycles are those that can move capital between buyouts, credit, distressed situations, and more, redeploying their people and their library wherever the best opportunities happen to be. The information advantage. One of private equity's most powerful and least appreciated strengths is its command of information. Large firms in particular can see across entire industries. They sit on so much proprietary data and have owned so many businesses that they can analyze the significant trends shaping a sector, often long after they have exited a given company. Monitoring an industry, even after selling out of it, becomes a source of ongoing insight. Sachin notes a subtle tension here. Information walls, which separate different parts of a firm to manage conflicts, are useful and often necessary, but they can also limit the ability to bring fresh perspectives across the whole organization. Size, scope, and scale amplify this advantage, because more reach means more signal and a better ability to design a winning strategy. People over size. For all the emphasis on scale, Sachin is clear that the people matter more than the size of the firm. A smaller firm with the right individuals at the helm can absolutely thrive, while a large firm without the right talent will squander its advantages. The quality, judgment, and character of the investors and operators are what ultimately determine outcomes. This is why the seamless relationship between the deal makers, the operating executives who actually run the companies, and the businesses themselves is so important. When those 3 work as one, value gets created, and when they don't, even a promising deal can falter. Sourcing and the depth of research. Finding the right deals is an art. Truly proprietary deals, the ones nobody else is looking at, are difficult to come by, but firms with a genuine edge can still find them by staying ahead of the curve, thinking creatively, and pioneering new ways of investing. The research process behind a single investment can stretch on for years, demanding patience and enormous effort before a dollar is ever committed. This depth of diligence, sustained over long horizons, is one of the defining traits of the industry and a key reason the best firms can act with conviction when the moment finally arrives. Where the industry should improve. Sachin is not uncritical of his own world. He argues the industry could do a much better job of presenting itself and explaining the genuine value it creates, rather than allowing caricatures to define it. More pointedly, he believes the rewards should be spread more widely, that the profits ought to reach beyond just the C-suite and the most senior partners to the broader set of people who contribute to a firm's success. And he returns to the theme of education. There needs to be far better public understanding of what private equity is and does, for everyone, not only for those already on Wall Street. Private equity goes mainstream. Over the past 2 decades, the industry has been transformed. What was once a specialized corner of finance has become a mainstream investment platform that now touches almost every part of daily life. Sachin points to how private capital reaches into businesses as varied as dating apps and even iconic institutions like Chelsea Football Club. The professionals in this field are defined by their alignment with investors and their relentless commitment to making their deals succeed. As private equity has spread, it has begun to resemble active management elsewhere in finance, with the same core promise: skilled people making concentrated decisions to generate returns. The democratization of alternatives. One of the biggest shifts underway is the democratization of private markets. Increasingly, retail investors, not just large institutions, are gaining access to alternatives, and firms are building bespoke products designed for them, each with different protections and different risk and return dynamics than the vehicles offered to big pensions and endowments. Sachin frames private market investors as active portfolio managers who can help construct a complete portfolio, balancing public stocks and bonds against real estate, infrastructure, and private equity. As the language and concepts become more digestible, this once exclusive world is opening up to a much wider audience. Opportunities and risks ahead. Looking forward, Sachin offers concrete thinking about where value may lie. He points to hybrid capital and tactical opportunities, structures that can offer an attractive risk and return profile with a relatively low chance of losing money. He notes that technology investments have become considerably cheaper than they were a few years ago, making them worth a fresh look. And in an inflationary environment, he highlights assets that can serve as natural hedges, such as infrastructure and real estate. Throughout, his emphasis is on diversification, bringing private markets alongside traditional holdings, and on the discipline of balancing day-to-day investing with a genuinely long-term strategy. Investing at the family office. Finally, Sachin applies these lessons to how he invests his own capital through his family office. The single most important consideration, he says, is people. When committing to a fund, you must weigh the quality and character of the individuals involved and whether their interests are truly aligned with yours. It's the same principle that defines the best firms, turned inward. He shares some of his favorite anecdotes from the book and closes on a note of hard-won simplicity, a life lesson that it is perfectly fine to keep things simple and to follow a plan, wisdom he wishes he had absorbed earlier. For a business built on complexity, it is a fitting place to end.